Hello again, I'm Rachael from Willow Financial Services. Just as a tree grows and flourishes with the right care, your finances can too. Today I'm going to demystify investing, explaining how it works and how it can help your wealth grow and thrive. We begin with, what is investing? Investing is the process of allocating money with the expectation of achieving a profit. Think of it as planting seeds in fertile ground, ready to harvest later. It can involve a wide variety of assets, such as stocks and shares, also known as equities, properties, and/or other assets. Investing is different from saving. While saving is about putting money aside for short-term future use, investing is about making your money work for you, offering the potential for higher returns. However, it's important to understand that investing involves risks, including market volatility. This means the value of your investments can and will fluctuate over time. There will be periods when your investments increase in value, but there will also be times where they decrease. This is completely normal when investing, but it's crucial that you are prepared for these emotional ups and downs. A long-term investment strategy takes this volatility into account, rather than focusing on these short-term fluctuations. So how can we understand the stock market? The stock market is a network of exchanges where shares of publicly listed companies are bought and sold. When you buy a stock, you're buying a small piece of ownership in a company. The stock's value will fluctuate based on factors like the company's performance, economic growth, and market sentiment. Understanding how investments grow is key to maximising your financial tree's potential. The growth of investments is primarily achieved through two channels. You have the increase in the value of the holding and the dividends. So on the value of your holdings, when you invest in stocks, bonds or funds, you're buying a piece of an asset. And the value of this will increase or decrease over time due to factors such as the company growth, economic conditions and market trends. So as the value rises, so does the worth of your investment. Then you have dividends. Dividends are a portion of a company's profit, and these are paid out to shareholders. They're a way for investors to earn income from the investments. However, instead of taking these dividends as cash, you can choose to reinvest them. This means using the dividend payment to buy more shares. Reinvesting your dividends is a powerful way to compound your investment's growth, as you're increasing not only the value of your initial investment, but also the number of shares you own. Over time, this can significantly accelerate the growth of your portfolio compared to if you just took those dividends as income. So which investment products should you choose? Different investment products serve different purposes. An individual savings account, that's an ISA, is a tax-efficient way to save or invest, as gains are not subject to capital gains tax and withdrawals are not subject to income tax. Pensions, such as workplace or personal pensions, offer free money by way of tax relief on contributions, and these grow tax-free until retirement. I do have a full video on pensions, which I will link to. Investment accounts offer flexibility, but lack the taxable benefits of the ISA or the pension. These are subject to capital gains tax as well as income tax on the dividend withdrawal. And investment bonds are a useful tool for estate planning and tax management, especially for higher rate taxpayers. Long-term investing is about compounding returns over time, and it's the concept of earning returns on your returns. The longer you stay invested, the more time your money has to grow through the market cycles. This approach requires patience and a tolerance for short-term market fluctuations, focusing on the potential for significant growth over several years or even decades. If you are planning to use the money within 3 to 5 years, then this should not be invested, but saved in a high interest paying account instead. One key decision in investing is whether to purchase individual company shares or to invest in a fund. While holding shares in a single company can offer significant rewards if the company performs well, it also carries a high level of risk. If that company faces downturns, your entire investment can be affected. We call this a lack of diversification or putting all of your eggs in one basket. It also relies on the investor keeping a very close eye on those companies and deciding when to buy and sell. Trading can be costly in both time and money. Funds, on the other hand, are open to multiple investors, allowing them to buy into an already diversified portfolio of stocks, bonds, and other assets. By investing in a wide range of asset classes and companies, you spread out the risk. If one asset or company within the fund underperforms, the others can help offset the losses. Therefore, for many investors, funds can be a more suitable and stable investment option. So active or passive? Active funds are managed by professional fund managers who make informed decisions based on extensive research and market analysis. They can usually use all of the asset classes and available investment techniques, allowing them to potentially generate the best return for the portfolio. These types of investments do have higher charges. Passive funds will work in a similar way, but instead of having a fund manager deciding on the holdings, these will often mirror an active fund or a set index such as the FTSE or the S&P. This type of fund has much lower charges. How much risk do you take? When it comes to investing, understanding your risk profile is key. Your risk profile is your willingness and ability to take risks. It includes your attitude to risk, which is your personal comfort level with the uncertainty and the ups and downs in the value of your investments. Some investors are more risk averse, preferring stability and lower returns, while others are more risk tolerant, willing to accept higher volatility for the chance of greater returns. Another critical component is your capacity for loss. Now, this refers to your financial ability to withstand losses without it significantly impacting on your lifestyle or financial goals. It's about how much you can afford to lose at any given time, considering your overall financial situation. This includes your income, savings, your debts, and any dependents. It's important to ensure that your investment aligns with your risk tolerance and your capacity for loss. A well-balanced portfolio should reflect these aspects, providing a mix of assets that can help you achieve your financial objectives while staying within your own comfort zone for risk. So what is the role of a financial plan when investing? A well-crafted financial plan is essential for tying together all aspects of your investment strategy. A comprehensive plan will provide a roadmap for your investment journey, ensuring each decision aligns with your overall financial objectives. You shouldn't begin to invest on a whim, but instead take the time to understand your whole financial position before beginning. So here's the compliance stuff. Willow Financial Services is a UK-based FCA-regulated firm, and therefore the information in this video is aimed at UK residents. The value of investments and the income they produce can fall as well as rise. You may get back less than you invested, and tax treatment varies according to individual circumstances and is subject to change. We do not provide advice on individual stock holdings. So in conclusion, understanding investing is key to nurturing and growing your financial tree. It can be complex, but with the right strategy, it can help your wealth grow significantly. At Willow Financial Services, we're here to guide you through this journey, helping you to plant the right seeds for a successful future. We have a guide to investing on our website, as well as a whole heap of other useful workbooks and guides, so please go and check those out. Please also follow us on social media for more hints, tips and guidance. You can contact us for personal advice, and please like, share and subscribe for more financial insights. Until next time.